Welcome to the deep dive. Today we're taking a stack of documents, the consolidated financial statements, the annual report for Oyak, Yatırım, Menkul, Değerler, and we're going to translate them into clear, actionable knowledge for you, the retail investor.
That's right. And we're looking at their performance right up to September 30, 2025.
Now, before we jump into the numbers, there's a really critical piece of context we need to establish.
We absolutely do. Everything we're analyzing today, every single figure, has been prepared under what's called TFRS 29.
High inflation accounting.
Exactly. It means every Turkish lira figure you hear has been restated to the purchasing power as of September 30, 2025. This is so important because it lets us make real apples-to-apples comparisons with last year.
It strips away all that noise from currency depreciation.
It's the only way to see what's actually going on.
That context is everything. And if you want more insights like this to get ahead, go ahead and hit that like button, subscribe, and of course, share this deep dive with someone who'd find it useful. Wait, let's unpack this. Let's first get to know the company a little. Oyak, Yatırım, founded in Turkey way back in 1982, based in Istanbul. But what do they actually do?
Their core business is capital markets. They're what's known as a full-service brokerage house, or a Geniş Yakili Araka Kurum. They've had that authorization since 2015.
So that means everything, from basic trading all the way up to...
All the way up. Brokerage, portfolio management, running public offerings, investment consulting, even repo and reverse repo transactions. It's the full spectrum.
So we're talking about a pure financial services group here, not a company with factories or, a heavy industrial footprint.
No, not at all. Their physical assets are their offices and, crucially, their IT infrastructure. But their operational scope, as you look at the subsidiaries, that's where the story gets really interesting.
It seems really diversified.
Very. And the subsidiaries are, well, they're key to their current profitability narrative. They own 100% of Oyak Portfolio Yönetimi, which is their asset management arm.
Okay.
They also fully own the insurance brokerage, Oyak Sigorta, which even has an international office in London.
Oh, interesting. Oyak Global Risk Services.
That's the one. And on top of that, they hold a big stake, about 47%, in an investment partnership. So you can see they're selling a lot more than just stock trades.
Let's talk about the scale of the operation then, the personnel figures. Something immediately jumped out at me. It looks like they're getting leaner.
That's a critical point. As of September 2025, the group had 247 employees.
Which is down from almost 300 at the end of 2024?
Right, 294. So that's a notable reduction. And you have to ask, is this a strategic move towards efficiency, or is it a reaction to stress in one of their business segments?
That's a great question, because we know from the reports that two of those subsidiaries, the portfolio management with 16 employees and the insurance brokerage with 75, are actually highly profitable.
They are.
So does that mean the staff reduction is hitting the core brokerage division? The one we're going to see is, well, struggling a bit.
That's the lens we have to use. Now, as for who owns the company, the major shareholder is Ordu Yardımlaşma Kurumu, Oyak, with almost 70%.
And the rest is publicly traded.
About 30%, yes. Their paid-in capital is 300 million lira, but their registered capital ceiling is $1 billion. So they have plenty of room to raise more capital if they ever needed to.
Right. And we don't have super detailed notes on the board's makeup, but we do see what the senior executives are paid.
We do. For the first 9 months of 2025, the general manager, the deputy GMs, the directors, their total compensation came to 78.8 million lira.
And that's up from 71.3 million in the same period last year, even after adjusting for inflation.
Yes, a real term increase in executive pay, which is an interesting detail to hold on to, especially when we look at the operating profits in a moment.
Okay, let's do that. Let's move into the industry context. Oyak Yatırım is a big player in the Turkish financial sector, but that's segmental data. I think it's note 3. It really tells a story of where the pressure is.
It's fascinating, isn't it? It shows how much heavy lifting that diversification is doing for them. The brokerage segment, the Iraqi Kurum, it holds the vast majority of the assets.
A huge amount. 16.89 billion lira in current assets.
So you'd expect that to be the main profit engine, right? The biggest part of the business.
But it wasn't. It was actually the only segment that reported a loss for the first 9 months of 2025. A loss of 193 million lira.
Exactly. That's a huge tell. It implies some pretty severe competitive pressure or maybe high internal costs, something specific to the core brokerage business in this high inflation world.
Meanwhile, the other parts of the company are thriving.
Thriving is the word. Portfolio management was a powerhouse. It brought in 263 million in profit, and the insurance arm added another 130 million.
So the big insight for an investor here is pretty clear. If you're buying into Oyak Yatırım right now, you're not really betting on the brokerage. You're betting that the asset management and insurance profits can keep carrying the whole group.
That's the core of it. And if we apply a quick SWOT analysis to that, it lines up perfectly.
The strength is that diversified income. It's what's preventing an overall loss.
The weakness, a really severe one, is that the massive core brokerage business is unprofitable right now.
Which creates an opportunity to fix it, I suppose, while leveraging the parts that are working?
It does. But the overarching threat is that macroeconomic environment. Those extremely high financing costs and high inflation are a constant weight on the business. It says so right in the risk notes.
Now we can move on to our analysis of the performance itself. Let's start at the top line with revenue.
Okay, so in real inflation-adjusted terms, revenue actually saw a modest increase. It went up to about 20.2 billion lira from 19.1 billion in the same period last year.
So sales are up. That sounds good.
It does, but the costs grew faster, a lot faster. Gross profit actually went down pretty significantly, from 6.5 billion down to 5.85 billion lira.
Which means their gross profit margin got squeezed.
Exactly. It shows they're having some trouble with cost control, or maybe they just don't have the pricing power in this environment.
And that squeeze, it flowed right down the income statement, didn't it? Operating profit was also down.
It was. It dropped from 5.1 billion in 9M 2024 to about 4.5 billion in 9M 2025. And this is what makes the final bottom line number so surprising.
This is where it gets really interesting.
It really is, because despite all that pressure on their margins, the group pulled off this phenomenal recovery in net income. They swung from a net loss of 382 million lira last year
to a net profit of 202 million lira this year. That's a massive turnaround, over 500 million lira.
A huge swing. We need to figure out how they did that, because if operating profit was down, the recovery can't be from their main business operations.
It has to be purely financial then.
Precisely. And the main driver was a huge and very successful effort to slash their financing expenses.
How much did they cut?
They cut them by nearly 1 billion lira. Financing expenses dropped from 3.36 billion down to 2.47 billion. That one move is what flipped the entire result.
And to do that in an environment with sky-high interest rates, that suggests some very aggressive and smart financial management. They must have either paid down a lot of expensive debt or found a way to refinance it much more cheaply.
It's a huge win for their finance team, no question. It shows real strategic maneuvering.
And the result for shareholders.
A big leap in earnings per share. It went from a negative 1.26 lira per share to a positive 0.67 lira.
Okay, so let's turn to the balance sheet and see how all that maneuvering affected their stability. It looks like they did some serious deleveraging.
Deleveraging is the perfect word for it. Total assets fell from 27.1 billion at the end of last year to 22.2 billion by September. And most of that came from a sharp drop in trade receivables. But crucially, their liabilities fell even faster. Short-term liabilities went from 17.3 billion all the way down to 12.1 billion.
And that's from paying down borrowings and managing their payables.
Exactly. And when you look at the capital structure, this had a hugely positive effect on their solvency.
So how does that play out in the ratios?
This is probably the most critical metric for you to watch. Shareholders' equity actually went up a little bit to 9.7 billion. But because the assets dropped so much, the equity to total assets ratio improved dramatically.
From what to what?
It went from 35.2% at the end of 2024 up to 43.8% in September 2025. That's a major de-risking move. It shows a much, much stronger financial base.
And what about their cash flow? Do they have the cash to support all this debt repayment?
They did. Operating cash flows were still very strong at 2.18 billion lira. And you can see the proof of that deleveraging strategy right there in the cash flow statement.
A big outflow for financing activities.
A net outflow of 2.1 billion lira. It confirms they were generating a ton of cash and using it to pay down debt and stabilize the balance sheet.
So what's left? What's the debt picture look like now?
They still have about 6.7 billion in short-term borrowings. It's a mix of things. Some bank loans, but it's mostly capital market instruments.
Like bonds.
Right. Issued securities, or bonds, make up 2.7 billion, and another 3.5 billion comes from the Borsa money market.
So they rely more on market-based financing than traditional bank loans?
Much more. It shows they're sophisticated players in the capital markets themselves, which makes sense.
Okay, let's pivot to their investment portfolio.
Yeah.
Because this is another huge part of their balance sheet.
It's massive. 13.1 billion lira in total financial investments. And almost all of that, 12.9 billion, is held in investment funds.
And the accounting for those is key, right? They're marked at fair value through profit or loss.
Yes, which means any change in the value of those funds, up or down, hits their income statement immediately. It doesn't just sit on the balance sheet. It creates a lot of potential volatility.
Which brings us straight to risk. Price risk, specifically.
And this is where you, as an investor, really need to pay attention. Because of the sheer size of that fund portfolio, a small 5% drop in the BIST stock index, it would only cause a 2.2 million lira hit from their direct equity holdings. But that same 5% market drop would trigger a staggering 649.4 million lira negative impact on their pre-tax profit.
Wow. Just from the valuation of those investment funds.
It's extreme leverage to market movements.
And the other big risk in this economy is obviously interest rates.
Precisely. They are very sensitive there. The report shows that a 1% increase in interest rates would wipe out about 679 million lira in pre-tax profit.
But on the flip side,
Yeah.
1% decrease gives them a nearly 700 million lira gain.
So their profitability is highly leveraged to central bank policy decisions.
Let's quickly hit some of the critical footnotes. We have to mention that inflation adjustment again, TFRS 29.
Yes. The adjustment factor they used was 1.25430. To put that in simple terms for you, that number means that something worth 100 lira at the start of the period is treated as being worth over 125 lira by the end, just to keep its value real.
That's the level of inflation they're fighting. It makes that net profit turnaround even more impressive.
It really does.
We also saw a huge number under contingent liabilities, 5.1 billion lira in guarantees. What's that about?
That's a critical operational number. Most of that is guarantees given to Taka's bank.
The central clearinghouse for the stock exchange.
That's right. As a big brokerage, Oyak Yatırım needs huge trading limits to operate. That 5.1 billion is essentially the collateral they have to post to support all their market activity. It's standard practice, but the size of it shows you the scale they're operating at.
And one last thing, their foreign currency position.
What's fascinating here is that they actually maintain a net positive FX position, about 126 million lira. So if the Turkish lira weakens, they actually stand to benefit a little bit as their foreign currency assets become worth more in lira terms.
Okay, so let's put this whole puzzle together. What's the final verdict on Oyak Yatırım's performance?
I think it's a story of strategic financial resilience winning out over some serious operational pressure.
So the foundation is strong.
The foundation got much stronger. They aggressively cut their financing costs, they deleveraged, and they boosted their equity ratio from 35% up to almost 44%. That debt management is the absolute key to this story.
But operationally, the core brokerage is still a drag.
It is. It's struggling. But the portfolio management and insurance segments are proving their worth. They're covering those losses and showing just how valuable that diversification is.
But you're still left with this significant exposure to the stock market through those funds and to interest rate changes.
That's the catch. This newfound financial resilience is still very dependent on things outside their control, on overall market stability.
Which leads to a final, really important question for anyone thinking about this stock.
Yes, and it's a question I want to leave with you. Considering that the core brokerage arm, the business that defines the company's public identity, is currently losing money, how much reliance should you, as an investor, place on the long-term sustainability of these huge profits from asset and portfolio management to determine the group's future value?
The difference between a public identity and their actual profit engine, that's what you need to think about. Thanks so much for joining us on this deep dive.
It was a pleasure.
And don't forget to like the video, subscribe to our channel, and share this content with someone who needs these insights. We will see you next time.